If parts 1 and 2 of this video series, with their focus on bubbles and crashes, have put you off investing, then part 3 is designed to redress the balance. That's because the next key lesson to learn from market history is to stay calm. All investing involves a degree of risk, and market volatility is inevitable. It goes with the territory. But more than that, there's a direct link between risk and expected return. And that, by the way, is not a theory, but a mathematical fact, as confirmed in the capital asset pricing model, which earned its authors the Nobel Prize in economics.
There are really sort of two key takeaways, if you will. One is the most efficient strategy for an investor is to hold a broadly diversified portfolio reflecting the market of securities that are available. And the second is that there will be a reward in higher expected return for bearing risk, but the kind of risk for which the reward should be available is the risk of doing badly in bad times.
The problem is, of course, that in those bad times, investors are often emotional. When prices fall sharply and further falls are predicted, we tend to panic, to reduce our exposure or bail out altogether. But history shows that's just the wrong thing to do, because almost invariably prices eventually recover.
Going back to the end of 2007, the publicity in the news was all very, very doom and gloom. We had a potential collapse of some pretty significant countries, in particular Greece. Then we had Cyprus. They were talking about the failure of Spain, Ireland, and we had to prop up the currencies, we had to prop up the banks. In fact, I remember there was certain journalists and commentary on the TV that was saying that this is the next Great Depression and it's going to be like the 1930s for the next 10 years.
It's because it was the most recent crash that 2008 is the one we tend to focus on today. But all through market history, there have been events which seemed catastrophic at the time, but in hindsight appear a blip. Take the famous bubble of 1720, for example, when the South Sea Company collapsed like a house of cards.
If you had stayed in, you would have, a few years later in 1723, you would have received compensation for your shares, and in fact, as a result of that, even though investors felt a little bit sore in London for having experienced some losses, they stayed faithful with the stock market as a concept, and the infrastructure of stock trading in London, as well as the appetite of investors for investment risk, largely remained intact.
In fact, not only do markets recover, they often do so far more quickly than expected.
After we've hit an absolute peak in volatility, how long does it take for volatility to go all the way back to its long-term mean? And the answer is, if we look back at the 11 biggest peaks in volatility since the 1980s, it takes typically under 100 days. To get halfway back has on average taken only 11 days. So if you were thinking of adjusting your investment strategy to respond to a peak in market volatility, by the time you've actually got around to doing anything, it's too late anyway.
The 1974 crash, the market fell, and I can remember people saying, this is the end of the stock market. The stock market will actually go down to zero. And pension funds were just desperately selling equities at the end of 1974. And yet 1975 saw the biggest rise, I think, in any month that anybody had ever seen.
Every investor's experience is a product of two factors. It's the capital market return that is being offered by the securities markets around the world, but then it's shaped by your response to those capital market returns, your own behavior. We've seen too many sad stories of people who had every opportunity presented to them by the capital markets to have a very rewarding investment experience, and they've made a hash of it by dashing into the markets after they've gone up and then bailing out of the markets after they've gone down.
Now you might be thinking, okay, I get it. I should ride out any volatility because markets always recover. But wouldn't it be great if I could just get into the market as a bull run begins, as one did in 1990, and get out again when it ends and a new bear market begins in 2000? Well, hold that thought right there and join us again for part 4.